we are, back discussing what to do in a sell-off. Sell. And how to figure out what the right approach is, given how difficult and different they all are. We covered the crash of 1987 as an example of one of the most horrific and quick declines imaginable. And yet there was no economic ramifications whatsoever. Many thought we had to be on the verge of a recession because the stock market projects what is supposed to happen in the future. It's kind of an early warning system, but not that time. It was a sell-off full of sound and fury that signified nothing. Same with the two flash crashes that we've been through, 2010 and 2015. The sell-off of 2007 to 2009, though, was exactly the opposite. It was a multi-year decline that started when the Federal Reserve raised rates 17 times in lockstep, trying to cool an economy that had already long since cooled off. It's the most dangerous kind of sell-off. What we call a systemic risk decline. And it's one that we can't trifle with, and we got to spend some time on. Fortunately, they don't happen very often. Call it, say, how about twice in 80 years? The first being the Great Depression. Unfortunately, every time we have a severe couple-day decline, we hear this Great Recession bear market invoked. Lots of investors scurry out believing that the sky is falling, and then they never come back, and they lose money, and it's breaking my heart here. So let's set the stage. Back in October of 2007, the stock market peaked at a little more than 14,000 when, as I mentioned, the Fed raised rates over and over and over again 17 times, and the economy, after teetering for just a bit, fell off a cliff and took the stock market with it. It's one of those things that you could have seen coming if you had paid attention, done a lot of talking and some homework, or at least paid attention to me. When back on August 3rd of 2007, I excoriated the Fed for continuing to raise rates, oblivious to the damage it was doing to the real economy. My people have been in this game for 25 years, and they are losing their jobs, and these firms are going to go out of business, and he's nuts. They're nuts. They know nothing.
Cramer.
I have not seen it like this since I went 5 bid for 500,000 shares of Citigroup when I got hit in 1990. This is a different kind of market, and the Fed is asleep.
Okay, but here's the thing.
Bill Poole is a shame. He's shameful. They know nothing. They know nothing. They know nothing. They know nothing.
Oh, excuse me. What did I mean by that? Well, shortly before I came out to the set that moment to be interviewed by my old friend Aaron Burnett, I had been talking to the head of one Wall Street firm about problems in the mortgage market. Pretty much everyone who followed this market, which is incredibly important to the health of the economy, knew that there were a lot of unsound practices occurring. Still, it was jarring when I was told by this executive that he couldn't believe how many people were beginning to default on their mortgages. He talked about how many mortgages of the 2005 vintage, he used a term that I had really before then only associated with fine wine, just weren't money good. Something that only had happened once in our country's history and was never supposed to happen again. The Great Depression. I was aghast. But you know what? I had a lot of friends and a lot of firms, so what I did, I started making a lot of calls. I wanted to see if this 2005 vintage thing was in trouble everywhere. I was ashen when I got off the phone as the problem seemed to be spreading like wildfire. I called mortgage bankers. I called guys who ran major Wall Street firms. Everybody said it. And that's why I went off so strongly on my rant. Oh, well, the Fed didn't listen, especially Bill Poole, who at the time was an important Fed official who was so sanguine about things that I had to single him out in the rant. Years later, I found out when the Fed's transcripts were released from that period that my rant was brought up. And the Fed had a hearty laugh about it. We then had a series of horrendous defaults of large banks and savings and loans, some of which were thought to be too big to fail and failed anyway, including the largest savings and loan and 2 of the largest and most fabled brokerage houses. I did my best to try to get people out, including going on the Today Show, to urge people who needed money near term to take it out of the stock market, lest it be lost. Whatever money you may need for the next 5 years, please take it out of the stock market right now. I don't think many listened, and the market fell another 40% before it bottomed. If you had bought any time from when the stock market peaked at 14,000 until it was cut more than in half by March 9th of 2009, you did lose a fortune. So how do you know to avoid buying this kind of dip? Isn't that what we need to learn? How do you avoid this kind of dip versus buying that Black Monday opportunity of 87? The first thing you have to ask yourself is about the economy. Is business really getting crushed? Is employment so important when considering the direction of the stock market falling off and falling off hard? Is the Fed standing pat or even raising rates when there are signs of real cracks like major firms going under or big companies unable to pay bills? Are there actual runs on multiple financial institutions around the country, not just in one area? If the answer is yes, then you have a decline that could be deeply rooted and joined at the hip with the real economy. And that has what I mentioned is systemic risk, meaning that the entire country could collapse. That's how it was back then. And it is why I get so angry when I hear people say, this is going to be as bad or worse than 2007, 2009, when there's, of course, nothing like that occurring because, like I said, only twice in 80 years. You don't expect systemic risk to continue happen. That's not the way it works in our country. Second, if you want to know if there's anything in place that can actually save the economy or actually turn it around, that's important, too. Even as the government tried to intervene with a troubled asset program and the SEC tried to institute rules that forbade short selling, none of those things mattered. What brought the market out of its funk was a statement by Ben Bernanke, a forceful statement on 60 Minutes, no less, that he would no longer let any more banks go under in our country. Before that, we had watched as the Fed had pretty much indicated it was unable to stop anything dramatic from occurring. Bernanke was no longer worried about such niceties, and a bottom was put in. Were there ways to spot the bottom? I got a couple of signs that can help. One that I monitor closely is the Standard & Poor's Oscillator. That's a paid subscription product that I get, which is updated after the close of trading every day. It measures buying or selling pressure. When you get a -5, that indicates that there's most likely too much selling. When you get a -10, you got to do some buying. We were getting signals that were much worse than that near the bottom as a sign that it was time to buy. Another way to look at it, I like to say who's been pessimistic or concerned about stocks, but has been reluctant to say anything positive, who then changes his tune. The best example of that kind of switch came from the late, great Mark Haynes, who had this to say back then.
However, I'm going to step out on a limb here.
This is the big, hold on, everyone. We've been waiting for this.
I think we're at the bottom. I really do.
Look at that, March 10 of 2009, the day after Bernanke was on 60 Minutes. And that's why we call it the Haynes bottom. It bottomed. It was that much of a contrarian call from someone who hadn't been willing to make one until that moment. Now, it certainly made a ton of sense to sell when I said to sell. But before you say to yourself, what happens if no one warns you again the next time? Well, you know what? I've got some good news for you. It's a little sobering, but it's good. If you waited long enough, 6 years to be exact, you actually did get back to where you were before the bear market began. All right. Yeah, 6 years. But if you had sat tight, you eventually did get back to even. And since then, well, of course, you made a lot of money. Yes, it would have been better to take something off the table. But one of the reasons why I am always stressing that it might just pay to sit tight if you haven't sold is because even in the worst stock market and economic moment of our lifetime, you still did fine if you bought and held. So here's the bottom line. Beware of the Chicken Littles of the world. Be mindful that there are tons of people who cry wolf every time we're down for a couple of days. But then again, there has been one time where it paid to actually sell, when there was real systemic risk, remember that term, to the U.S. economy. Unless there is, again, it's okay to do some selling, but otherwise, maybe just sit tight and wait for those signals to buy. Donna in Pennsylvania. Donna.
Hey, Jim. My husband watches you all the time and really trusts your opinion.
Oh, fabulous, fabulous.
I want to invest $5,000 for my grandson's first birthday for him to use for college or a down payment on a house when he gets older. I know that it's a volatile market, and I want to invest long-term, but I want to be defensive against sell-off. So what's my best way to go?
All right, here's what we're going to do. We're going to divide that $5,000 into $1,000 each time. You're going to put the $5,000 in, $1,000 at a time. Why don't you do this? Wait every other month, $1,000, say January, then $1,000 in March until it's all in. That way, if you do get a big sell-off in the interim, then put all of it in that's left at once. That's my rule, and it's worked for me literally since 1979. Let's go to Jacob in Florida. Jacob.
Hey, Mr. Cramer.
How are you,
Thanks
sir?
for taking my call. This is Jacob from Tallahassee, Florida.
Tallahassee. Let's go to Jim and Mills for some barbecue.
Yes, absolutely. My question for you, sir, is when there's a bear market, and I have a stock that's been performing well consistently in the past. What factors do you look at to decide whether to get out or if you should hold on to it for the long term?
Well, in the end, it's going to come down to if it's a bear market, we're going to look for companies with incredible balance sheets that we think have not borrowed too much money and therefore can ride it out. And then we'll ride it out right with them. Sellers beware. Beware of the chicken littles. Unless there's systemic risk, be mindful when investors cry wolf. Much more Mad Money ahead, including interest rate intrigue. I'm explaining how to handle sell-offs in the wake of interest rate hikes. Then, think I've covered all the ways to sell off? Think again. My strategy session continues. And I'm taking all your tweets, so send your questions my way. And of course, stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.